Ready to invest in something even Warren Buffett has put billions into? Stick around, because we're about to make US Treasury securities sound more exciting than a spy thriller. Well, almost. Today we're diving into the world of US Treasury securities. Now, I know what you're thinking. Michael, that sounds about as exciting as watching paint dry. But hold on to your wallets, because understanding treasuries could be the key to building wealth without losing sleep at night. Let's break it down, shall we? Uncle Sam offers three main types of securities: treasury bills, treasury notes, and treasury bonds. Think of them as loaning money to your rich uncle, who always pays you back, with interest. First up, we've got treasury bills, or T-bills. These are the sprinters of the treasury world, short and quick. They mature in 1 year or less. Here's the kicker: T-bills don't pay regular interest. Instead, you buy them at a discount from their face value, and when they mature, you get the full face value back. The difference? That's your profit, your interest. And the added bonus? You don't pay state taxes on that profit. It's like buying a $100 bill for $95, and Uncle Sam magically turns it into $100. Tax-free magic. Next, we've got treasury notes, or T-notes. These are the middle distance runners with maturities of 2 to 10 years. Unlike their speedy T-bill cousins, T-notes pay interest every 6 months. It's like getting a thank you card from Uncle Sam twice a year. But instead of the heartfelt message, you've got cold, hard cash. Last but not least, we've got treasury bonds, or T-bonds. These are the marathon runners of the bunch, with maturities of 20 or 30 years. Like T-notes, they pay interest every 6 months. The special takeaway on these is these bonds cannot be called away early. It's like having a loyal friend who sticks with you through thick and thin for 30 years. Back in 2008, during the financial crisis, I had a client. His name was Dave. Dave was panicking as he watched his stock portfolio nosedive faster than a skydiver without a parachute. But you know what stayed steady as a rock? His treasury bonds. While the rest of the market was doing the cha-cha slide, Dave's treasuries were as calm as a Zen master. From that day on, Dave started calling his treasury bonds his financial teddy bears, because they helped him sleep at night, especially during market storms. Since then, Dave has had a bit of a mind shift in his thinking about the bonds in his portfolio. Let's just be clear, bond prices can go up and down, just like stocks. However, for Dave, he completely eliminates any bond market volatility by buying bonds with maturities that correspond with his future needs. He never sells a bond. He just waits for them to mature and then invests or uses the money for the need he had planned for. In other words, in Dave's mind, his bonds never go up or down in value. Now let's talk about a special type of treasury security that might just blow your mind: treasury strips. No, we're not talking about bacon here, although that would be delicious. Strips stands for Separate Trading of Registered Interest and Principal of Securities. It's like the government decided to make alphabet soup with their terms. Strips are zero coupon bonds, which means they don't pay regular interest. Instead, you buy them at a discount and get the full face value at maturity. It's like buying a baby money tree and watching it grow into a full-sized cash oak. Let's break this down with a real-world example. Say you've got an 8-year-old and you want to save for their college education in 10 years. You decide to invest in a 10-year treasury strip with a face value of $10,000. As of today, July 18th, 2024, you could buy this strip for about $6,400. That's right, you're getting a $10,000 bond for just $6,400. When your kid is ready for college in 10 years, boom, you'll get the full $10,000. That's a $3,500 difference. That's your profit, my friend. And here's the kicker: the yield on this strip would be about 4.279% annually. Not too shabby for a guaranteed return, eh? Now you might be thinking, Michael, why not just stuff this money under my mattress? Well, let me tell you, unless your mattress is magical, it won't turn $6,500 into $10,000 in 10 years. Plus, with the strips, you're locking in that 4.27% yield for the entire 10 years. Try getting that guarantee from a bank. But wait, there's more. Remember, you won't pay state or local taxes on that $3,500 profit. It's like getting a bonus dessert with your financial meal. Now, here's the deal, and you know I always like to give you the lowdown. Strips are more sensitive to interest rate changes than regular bonds. If interest rates go up, the value of your strips will drop more than a regular bond. But here's the beauty. If you're holding until maturity, who cares? You're still getting your $10,000 when your child is ready for college. And here's one more golden nugget for you. If you think interest rates are going to drop in the near future, strips could be your best friend. They'll likely see bigger gains in falling rate environments than a bond mutual fund or an ETF. It's like having a financial crystal ball. If you're finding this information helpful, please give us a like and subscribe. It really does help us a lot and keeps me from crying into my bond certificates at night. Now, you might be wondering, Michael, this all sounds great, but what's the catch? Well, the good news is there isn't much of one. These securities are backed by the full faith and credit of the United States government. It's like having Superman as your bodyguard, but for your money. Remember, investing in treasuries isn't about getting rich quick. It's about preserving wealth and earning a modest, reliable return. They're the tortoise in the investment race, slow and steady, but they get the job done without giving you a heart attack every time the stock market tanks. Here's a pro tip from my 30+ years of experience as a bond trader. Consider using a ladder strategy. This means treasuries with different maturity dates. It's like having a diversified portfolio, but instead of spreading your money across different stocks, you're actually spreading it over different maturities. And you're taking advantage when bonds come due, you're extending out to the long end of the curve, where typically in normal markets, we see higher interest rates. It can be quite beneficial. So are you ready to add some Uncle Sam approved safety to your portfolio? Remember, treasuries might not be the life of the investment party, but they're the responsible friend who makes sure you get home safely. Do your research, start small, and remember to think about your future cash flow needs, like retirement, buying a house, your child's college. The level of certainty that Treasury securities can provide is quite nice. Remember, treasuries might not be the most exciting investment out there, but they can play an important role in a well-balanced portfolio. If you use them right, you'll find that bonds can add some stability and some certainty to your investment portfolio. As always, make sure you understand what you're investing in and never invest money you can't afford to have tied up. And make sure you're not investing in something you do not understand. Until next time, this is Michael O'Donnell saying, always think of bonds if you're looking for an investment where you know exactly what you're going to get and when you're going to get it. To continue your fixed income journey, check out one of the videos on the screen now. Thank you so much for watching.